Well, it is more difficult, but you can't ostensibly say that value is going to outperform growth, because if you look at the trailing 3, 5, or 10 years, value has systematically lagged growth over that period. But it doesn't deter Delphi from doing what we normally do, is trying to buy high return on equity companies with strong balance sheets and cash flows at low multiples. Our average PE in the portfolio is about 12 times next year's expected earnings, while the S&P 500 is about 22 times next year's earnings.
Yeah, before we get to some of your picks, I remember you joined us back in August, and you were saying the overall S&P looks expensive. We've gone up sharply since then. So how does it look to you today? Well, by historical standards, it's high, because historically it's 16 multiple. The problem is you have the lowest nominal interest rates that you've ever had in the post-war era, when you have the 10-year under 1%. And as we all know, multiples run inversely to interest rates. So the lower the interest rates, you can justify higher PEs. And if you look at the top 5 stocks in the S&P, and they account for about 22% of the valuation, truthfully, the only one that's way out of whack would be Amazon, which is selling about 70 times next year's earnings, even though it's a great company. I mean, Apple and Microsoft are about 32 times, and Alphabet and Facebook around 27 times. While those are expensive, they have sustainable earning power and dominant franchises. It's the IPO market, and these what you referred to on CNBC as the stay-at-home stocks, which have nosebleed valuations, which are the greater fool theory of investing.
Yeah, so I wanted to ask you about those, Scott, because yes, lower interest rates might justify higher valuations overall for the S&P 500, but do they justify a 260 times multiple for DoorDash, a 225 times multiple for Palantir, 625 times earnings for CrowdStrike? I mean, where are investors even getting those numbers from?
I think it's a lot of euphoria built in. I mean, you cover the stocks. They obviously have interesting niches, and they make for good dialogue on CNBC, but this is really ridiculous. These companies, and including Airbnb and Snowflake, which will have no earnings next year, all have market caps to $50 to $100 billion. There are many great companies out there that don't have capitalizations anything close to that, otherwise on opening day or on the opening of the year. People are projecting much too far into the future. I mean, there might be interesting ventures, but they're certainly not good investments. They're way overpriced for what they are.
Shepard Smith here. Thanks for watching CNBC on YouTube.